Hello everyone, welcome back to my channel US Tax Concepts by Paul. In today's video, we are going to talk about what is a partnership and what are different forms of partnership in US tax. Before going into the video, I would request all of you to kindly like my video and share it with your friends and colleagues, and also please do not forget to subscribe to my channel. So with that being said, let's jump right into the video. So firstly, we are going to know what is a partnership. So partnership in context of US taxation is a business arrangement where two or more individual or entities come together to carry on a trade or business. The partnership itself doesn't pay taxes on its income. Instead, the income passes through to the individual partners and they are responsible for reporting their share of partnership income on their personal tax return. This is known as pass-through taxation. Partnerships are classified as pass-through entities under the US tax law. So as the definition says, partnership is a business arrangement where two or more individual or entities come together to form an active trade or business. But under US tax concept, partnership do not pay taxes. They are basically pass-through entities which passes on all the income to its partners, which can be an individual or entities, and it's their responsibility to report that income in their individual tax return and pay taxes on it. So after the definition, now we come up to the discussion of what are the different forms of partnership in US tax. So first one is general partnership. So in a general partnership, two or more individual or entities join together to run a business and each partner shares equal responsibility for the management of the business and its debt. For tax purposes, a general partnership is considered a pass-through entity, meaning it doesn't pay taxes at the partnership level. Instead, the profit and losses pass through to the individual partners who report their share of partnership income or losses on their personal tax return. So in a general partnership, all the partners, which are, as the name suggests, are all general partners. So their liability is also unlimited. The next type of partnership what we have here is limited partnership. A limited partnership has at least one general partner and one or more limited partners. The general partners have unlimited liability for the partnership's debt, while limited partners have liability limited to their investment in the partnership. Like a general partnership, an LP is a pass-through entity for tax purposes. So as already discussed, partnership do not pay taxes at its level. It passes on the income to his individual partners or entities who reports his income in their individual return and pay taxes on it. So a partnership is a pass-through entity. But in this case, a limited partnership, it also has one general partner and there can be one or more limited partners. But the difference between general partnership and a limited partnership would be, in a general partnership, all the partners are basically general partner and their liability is unlimited to the partnership debt. But in this case of limited partnership, there is one general partner who has unlimited liability, but the other limited partners have limited liability to their investment in the partnership. So the third one would be limited liability partnership, LLP. An LLP is a type of partnership in which all partners have limited liability, protecting them from most debt and liabilities of the business. LLP are often used by professionals such as lawyers, accountants, or architects. LLPs are typically taxed as pass-through entities. So, for an LLP, all the partners have limited liability to the face value of shares held by them in the partnership, and these limited liability partnership are used for specialized profession, as it mentions on the slide, by lawyers, accountants, or architects. The fourth one which we have is, it is a new concept which has been introduced recently, that is limited liability limited partnership. And triple LP or is a limited partnership where the general partner has limited liability. The limited partner's liability remains limited as in a traditional limited partnership. For tax purposes, triple LPs are generally treated as pass-through entities. So what's new in this triple LP or limited liability limited partnership is, in this kind of partnership, there could be more than one general partner, as in one or two general partner, and their liability would be limited to the face value of shares held by them in the partnership, and the limited partners also have limited liability as per the traditional limited partnership. Moving on to the next one, which is the last one, is limited liability company, LLC. While not technically a partnership, an LLC is a flexible business structure that combines elements of a partnership and corporation. LLC owners are called members, and an LLC can have one or more members. For federal tax purposes, an LLC with only one member is treated as a disregarded entity, like sole proprietorship, while an LLC with multiple members is treated as a partnership by default. However, LLC can be elected to be taxed as a corporation if desired. Basically, a limited liability company, LLC, enjoys both the features of a partnership and a corporation, and its owners are termed as members. So if there is a single member LLC or a sole proprietorship, then that is considered as a disregarded entity for federal tax purposes. But if it has one or more members, then by default it is treated as partnership. But if an LLC wants, it can elect itself to be treated as corporation if desired. With this, we come to the end of the video. Thank you for watching it till the end. If you like my content, please support my channel. Do like this video and share it with your friends and colleagues. And also do not forget to subscribe to my channel. I will keep on bringing more US tax concepts on this channel. Till then, thank you and take care.